Hey there, fellow investors. Welcome back to another exciting journey into the world of finance. Today, let's dive into bonds, a fundamental piece of the investing puzzle that often gets overlooked. In the simplest terms, a bond is like an IOU. Imagine you're lending money to someone and they give you a note promising to pay it back. When you buy a bond, you're essentially lending money to a company or government, and they promise to pay you back with interest over a set period. Think of it like this. You're giving a friend a loan, and they agree to pay you back with a little extra on top. This extra is what we call interest. That extra is the interest, your reward for lending the money. The interest rate can vary, but it's generally fixed, giving you a predictable return. Bonds are different from stocks. While stocks represent ownership in a company, bonds are a form of debt investment. With stocks, you buy a piece of a company and your returns depend on the company's performance. With bonds, you're lending money and getting a fixed return, making them generally less risky than stocks. Bonds come in different flavors, each with its own risk and potential reward. There are government bonds, corporate bonds, municipal bonds, and more. We'll break down the different types later on, so stay tuned to learn more about how bonds can fit into your investment strategy. Why should you care about bonds? They're like the reliable friend in the investment world. Bonds can provide a steady stream of income, especially compared to the roller coaster ride of the stock market. Investors, especially those closer to retirement, love bonds for their stability. When the stock market throws a tantrum, bonds can be a safe haven, helping to cushion your portfolio. Remember, investing is all about balance. Having both stocks and bonds in your portfolio is like having a well-balanced breakfast. It sets you up for success. Let's talk about the different types of bonds, starting with the big dog, government bonds. These are issued by, you guessed it, the government. When you buy a government bond, you're essentially lending money to the government to fund its operations. Government bonds are considered very safe because, well, it's the government. The most common type of government bond is the U.S. Treasury bond. These come in different maturities, meaning the length of time you lend your money for. Section 4. Corporate bonds investing in companies you know. Next up, corporate bonds. Corporate bonds are a fascinating way to invest in the companies you are familiar with and trust. These are issued by companies looking to raise money. Essentially, when a company needs funds for expansion, new projects, or even to cover operating expenses, they might issue bonds to attract investors. When you buy a corporate bond, you're lending money to that company. In return, the company promises to pay you back with interest over a specified period. Corporate bonds can offer higher returns than government bonds, which makes them an attractive option for many investors looking to maximize their earnings. But they also come with higher risk. The potential for higher returns is balanced by the increased chance of the company defaulting on its payments. After all, companies are more likely to go belly up than the entire government. This means that while the rewards can be greater, the stakes are also higher. Think of it like this. Lending money to your friend's startup is riskier than lending to a well-established company. The startup might have great potential, but it also faces many challenges and uncertainties. The startup might take off, or it might crash and burn. On the other hand, a well-established company has a proven track record and is more likely to provide steady returns. Section 5. Navigating the risks of bond investing. Now let's get real about the risks of bonds. Bonds are often seen as a safer investment compared to stocks, but they come with their own set of challenges and risks that every investor should be aware of. Just like any investment, bonds aren't risk-free. They can be affected by various factors that can impact their value and the returns you get from them. One risk is interest rate risk. This occurs when the interest rates in the market rise, causing the value of existing bonds to fall. When interest rates rise, the value of existing bonds can fall. This is because new bonds are issued with higher interest rates, making the older ones less attractive. It's like trying to sell your old phone when the newest model just came out. The old phone loses its value because everyone wants the latest version. Another risk is credit risk, especially with corporate bonds. This risk is related to the financial health of the bond issuer. If the company struggles financially, it might not be able to pay back its debts, including your bond. This can lead to a loss of your investment. Remember, diversification is key. Spreading your investments across different types of bonds can help mitigate risk. By diversifying, you can protect yourself from the potential downfall of any single investment.